Hello, and welcome to the 2026 Property Market Update for Queensland. I'm Angus Moore, and I'm the Executive Manager for Economics here at REA Group. Today, I'll be taking you through what we're seeing in housing markets, as well as the broader underlying economic conditions that we're seeing. To that end, I'll start with that economic backdrop to kind of paint a picture for where we are and how that's affecting housing markets. I'll then talk about the established market, what we're seeing in home prices, what we're seeing in activity. I'll then take a little bit of a detour into talking about rental markets, both because they're interesting in their own right at the moment, and also because of what rental markets are meaning for investor activity, because investors are a really important part of what we're seeing at the moment in housing markets. I'll then wrap up with a few themes that I think are going to be important over 2026 as we head into the rest of the year. So let's start with economic conditions. We kind of can't start with economic conditions without talking about inflation, because inflation's really been the just key theme over the last, 3 or 4 months. And you can see why on this chart. So this chart here is showing what we call underlying inflation. This is the measure of inflation that the RBA prefers to use because it strips out one-off effects. Think things like electricity subsidies or, changes in fuel prices that matter for inflation, but don't really matter for thinking about, the underlying momentum in inflation and where inflation might be headed. So this is the measure they like to use, and you'll kind of note two important things here. One is that huge spike in inflation that we saw coming out of the pandemic. That is why we saw the RBA raising rates at such a rapid clip during 2022 and 2023 was, inflation got way out of control. But the second fact you'll notice is more recently, we did get just back inside the target band, shown in the grey there, but that we've moved back outside it. And that in the red, the RBA's forecast, they're expecting that we're going to move higher from here and remain above their target band for probably 18 months or so. That's why we've seen the rate hike that we saw in 2026, and as we'll talk about in a moment, why further hikes are expected. It really is front and center for the RBA at the moment is what we're seeing in inflation. Where that leaves mortgage rates, this chart here kind of underlines. So what I'm showing here is the average new rate for an owner-occupier borrower. So, if you were to borrow today as an owner-occupier, what on average would you be getting from your bank? You can see that rates came down over 2025 as we saw those three cuts to the cash rate. But then we've started to come back up. And then in the dash line there, which flows through what markets are expecting is going to happen with the cash rate over the next 18 months, if that flows through as expected, we'll see, another hike and then potentially a second one by the end of the year. Depends on the day you look, but market pricing at the moment implies about a 40%, maybe 50-50 chance of a second hike by the end of the year. That leaves rates still a little bit lower than we saw at the end of, at the start of 2025, because that second hike is not guaranteed on market pricing at the moment, but still, mostly reverses the cuts that we saw last year. As we spoke about, that's largely due to inflation. The fact that inflation has come in stronger than the RBA would like it to is a big part of why we've seen these hikes, but it's not the only factor. The other factor that's been supporting rate hikes is unemployment, and that's what this chart here is showing. You can see in purple here, I'm showing the actual unemployment rate over the last 5 decades or so. And you can see that at the moment, kind of in the low fours, depending on the month you're looking at, we are not at the lowest we've ever seen, but very close to over 5 decades. Very low unemployment by historical standards. Now, this is unequivocally a good thing. Unemployment's bad. Low unemployment also supports housing demand. So this is, unequivocally good. But as you can see in the RBA forecast there, this is something the RBA largely expects to persist. They expect it to drift up a little bit, as we've kind of been seeing for the past few years, but still remain relatively low by what's been true historically. And importantly, probably lower than what the RBA considers neutral. Now, exactly what that is it's a bit of a slippery concept and hard thing to pin down. But broadly speaking, neutral is the level of unemployment and growth in the economy that the RBA considers consistent with inflation being within their target band. If unemployment's too low, the economy's running too hot, that pushes inflation up. So at the moment, that probably looking at this suggests that they think it's too tight, and that's also driving why we've seen rate hikes. So why? Why is unemployment so low? And why, perhaps importantly for those of you who, have your glasses on, did we actually see unemployment drop a bit at the end of 2025? Part of the story is here. Consumer spending actually started to pick up through 2025. So what I'm showing here is consumer spending relative to the end of 2019. You can see that big drop that we saw during the pandemic. Unsurprising, things were closed, people couldn't go and spend money on things. The big surge that we see post the pandemic as borders reopen, everything reopens, people go out and spend money again. But then if you move forward to sort of the end of 2023, 2024, consumer spending mostly tracks sideways. And this is actually a period in which we're seeing quite strong population growth. And so the fact that aggregate consumer spending is tracking sideways while population growth is quite strong means that in per capita terms, household spending was pretty soft. But you can see as we get into 2025, that line starts to pick up a bit. We do start to see a bit of a stronger growth in consumer spending. At the same time, as we'll talk about in a moment, that population growth has started to slow down. So this, suggests a bit firmer spending by households in general, and that's probably supporting, lower employment and supporting pushing up prices and inflation. Another, perhaps more complicated way to see it is this chart here, which breaks down economic growth into the types of spending that are supporting growth. So in red is private sector spending, and in blue is public sector spending. Those are the ones to focus on here. And the bigger the bar up, the more that type of growth is contributing to overall economic growth. So if we zoom into sort of, 2024, 2025, a couple things will stand out. One, there wasn't a lot of growth in private sector spending over this period. You can see those red bars are really quite small. Economic growth through that period really was supported by government spending. But as we get into 2025, you can see that situation starting to flip. Government spending starting to level off. That's partly the wind up of state infrastructure projects in New South Wales and Victoria. But also private sector spending is starting to pick up. And, that's consumer spending, as we were talking about before, but it's also investment by businesses, which has been picking up as well. So that, again, is supporting economic growth, and in the RBA's judgment and assessment in their recent cash rate decision, part of what's contributing to that pickup in inflation that we've seen. Right, moving away from economic conditions and talking a little bit more, kind of directly adjacent to housing, let's talk about population growth. So the chart on the left here is showing annual population growth for the country as a whole in purple and for Queensland in the orange. Two things you'll note from this chart. One, we've been through a period of really, really strong population growth over the past few years. We'll talk about why in a moment, but that's come down now. The second fact you'll notice is that Queensland typically grows faster than the country as a whole. And the reason for that is, I think, best illustrated by the chart on the right. So let's talk about that one. Chart on the right breaks down population growth into the things that contribute to population. So in the grey is what we call natural increase. We can mostly ignore that. That's sort of births, less deaths. But the interesting ones are blue, net overseas migration, and red, interstate migration. So in blue, you can see why we've been through a period of such strong population growth. Post the borders reopening, we saw a huge surge in inward migration, very little outward migration, and so big increases in population as a result of overseas migration. That adjustment process, though, now 4 years later, post borders reopening, has mostly worked its way through, and that's coming back down to a more typical pace, and that's why population growth is now back, at least nationally, towards a more typical pace. But for Queensland, it's actually the red bars that are the most interesting story. So the red is net interstate migration. That is people moving into Queensland, less people leaving Queensland for other states. Queensland has always, through its history, attracted more people than have left. But during the pandemic, those red bars were enormous. We were seeing huge inflows from elsewhere in the country into Queensland. That process has largely abated now. We are still seeing, strong flows of population into Queensland from other states. That remains true, but that pace that we're seeing is now back to a more typical pace, more like what we were seeing on average over the last 3 or 4 decades. You can see, the 2010s were actually a relatively slow period for interstate migration, after the mining boom. And you can see the flip side of that, the mining boom in the late 2000s, where interstate migration was very strong. Just digging into, where in Brisbane this interstate migration happens. This chart here breaks down Brisbane into internal migration. So purple here means people are leaving that part of the city for other parts of Brisbane or Australia, and red means more people are moving into it than leaving. And you can see that it is typically speaking, the more outlying areas where development is more active, that people are on net moving to from other parts of the city or the country. While the inner city typically sees people moving out of it to those more affordable regions. Now, that's not to say that the inner city is losing population overall. So the chart here on the right shows total population growth. So that's that internal migration plus people coming in from overseas. And so you can see that, once you factor in overseas migration, those inner city suburbs, particularly the inner city, still grow quite quickly. But that internal migration, which is often, going to be important for thinking about demand in the established market, is going to be focused on those more affordable areas. That's a nice segue to moving into what we've seen in home prices. And home prices in Queensland have been a big story. And I think this chart kind of clearly underlines why. What I'm showing here is how home prices have evolved relative to more or less the start of 2020. And you can see Brisbane and regional Queensland on the left there have seen prices more than double, that is growth of over 100% over the last 6 years. That is an astonishing pace of growth over such a short period of time. That means Brisbane's outstripped, national as a whole, but that's mostly due to Sydney and Melbourne, which you can see there on the right. Sydney and Melbourne just have not seen the same sort of growth that we've seen in Brisbane. Whereas Perth, Adelaide not shown, but looks very similar to Perth, have seen pretty similar performance to Brisbane. That strong growth has actually continued through 2025. Brisbane's still seeing pretty solid growth, not as fast as some of the previous years, but growth has been, remarkably solid despite the fact that we've seen prices double, which has, obviously made affordability a lot more challenging than it used to be. Just digging into Brisbane a little bit more. In the past year, we have seen a bit of outperformance from units. Over, sort of the last 12 months or so, unit prices are up 18% compared to detached up, about 13%. That's still very strong. 13% growth is still very, very strong for a period of 12 months, certainly well above average. But units have been, even more outperforming. Part of the story here is affordability constraints. The fact that we've seen prices double and rates go up very quickly has made affordability very challenging. And so another way to look at that is if we break the market up into sort of, the more affordable in blue versus the sort of middle part of the market in purple and the most expensive end in the red. And again, you can see kind of that same story. Those more affordable parts of the market, units rather than detached houses, have been better performing in the past few years and in the past 12 months amid, very challenging affordability conditions. And similarly, as we're talking about with internal migration, it is generally speaking the more affordable parts of Brisbane that geographically that have seen better performance. I don't want to draw too much of a distinction here. This growth's been pretty solid across a lot of the city here. We're not talking big differences here. But if you're looking at the areas in the past 12 months that have seen the strongest growth, it's, Ipswich Inner, Springwood in Logan, Forest Lake in Logan, North Lakes in Moreton Bay. So it is those typically more affordable parts of the city, consistent with that strained level of housing affordability. All right, I'm going to move away from home prices and just kind of briefly talk about what we're seeing in terms of market activity. And the short answer is it's been pretty quiet. So this chart here shows the number of new listings by month. I do it this way because, listings are obviously very seasonal. Lots of people list in October, November, very few people list in December. So you want to be able to compare month to month as you're going along. And so the way to read this is to follow a color that follows a calendar year, and then each month you can compare to previous years. And the blue in 2025 you'll see is below the average in black and below what we saw in 2025 in red. And that was true basically through the whole year. It was just a quiet year for Brisbane overall. That meant choice for buyers, stock on market was relatively limited. That's part of what's been supporting home price growth, as well as that population growth we were talking about before. This was not unique to one part of Brisbane or another. This chart here is just showing listings for that part of the city versus what's typical, that black line that we were talking about on the previous slide. You can see the whole city here is purple, meaning it's below average. There are some parts that are, a bit more below average. The East here was, a bit more below average than some other parts. But I wouldn't want to put too fine a point on that. It was, broadly speaking, pretty quiet across the whole city. All right. I'm going to take a little bit of a left turn now and talk about rental markets. And I'll start where I always start, which is with rental vacancy rates, because I think they're kind of the best way to summarize where conditions in rental markets are. So the rental vacancy rate shows at any given point in time, as at the end of the month, how many rentals were available for a prospective tenant to move into as a share of the total number of rentals that exist. Very low at the moment. You can see Brisbane and regional Queensland on the left. Rental vacancy rates are around 1 to 1.5%, depending on the month that you're looking. That is very low by historical standards. That's not unique to Brisbane. If you're looking on the right for the combined capital cities in purple or combined regional areas in the green, not quite as tight as we're seeing in Queensland, but still at very low levels. That said, if you look through the month-to-month volatility, and vacancy rates are very volatile month to month because, they depend on seasonal factors. More people move in January and that makes more rentals available than is true in, say, winter. And because it's at the end of the month that we take the rental vacancy rate, when in the month someone moves out can affect it. So it can be quite a volatile measure. But if you kind of look through the broader trend, Brisbane does look like it was mostly improving through the last few years. 2025, maybe less so. It does look like rental availability actually declined through that year. Though, it's still a bit higher than what we were seeing in 2022 when, we're at the kind of worst of rental availability and when rents were, as we'll talk about in a moment, absolutely skyrocketing. So there's some evidence that things are improved a little, though I would want to stress a little. It is still very competitive and very challenging for prospective tenants. What that means is rents are still growing quite quickly. Chart here is just median advertised rents, for houses and units. Brisbane on the left, regional Queensland on the right. Rents are still up north of 6% in the past year, which is still very strong growth, consistent with the fact that availability is quite limited, vacancy rates are very low. That said, that 6.5%, as you can see from the sort of steepness of the line there, is a slower pace of growth than we were seeing in 2022, 2023, when rental vacancy rates were even lower than they are today. And we were seeing double digit up towards nearly 20% at some points growth in rents. So still a very challenging picture for renters, but things are maybe starting to ease a little bit. But what that means, what those still very tight conditions mean, what that big growth in rents that we've seen is that we're seeing a lot of investor activity at the moment. And I think this chart's kind of the best way to see that. What this shows here is the number of new investor loans issued each quarter. What you can see is, big peak during the pandemic. That was not unique to investors. In fact, investors were, if anything, quieter than other buyers at this time. That was the fact that, during the pandemic, housing markets in general were incredibly busy. Big drop off as the RBA starts raising rates. But then coming into 2023, you can see investor activity starting to pick up as rates start to stabilize. And those very tight rental market conditions push rents up and up and up. And that starts to entice investor activity into the market. And that's continued through 2025. You can see, that line continues upwards. And investor activity today, the number of investors buying today, is basically equal to what we were seeing during the pandemic, which is very strong, brisk activity. In terms of where we're seeing that across Southeast Queensland, investors are overrepresented in the more affordable parts of Brisbane. You can see, kind of Ipswich and Logan there are seeing disproportionately high investor inquiry. Inner city Brisbane, unsurprisingly, also seeing very high investor inquiry. That's consistent with the fact that it's a very deep, large, liquid rental market. You'd expect to see a lot of investor activity there. But we're also seeing a lot of it down in the Gold Coast as well. You can see a lot of investor inquiry and activity there as well. And to some extent up on the Sunshine Coast, though not quite as strong as what we're seeing in the Gold Coast. Just to wrap up on investors, not to belabor it too much, I always like this chart as a way of thinking about how important investors are in housing markets at the moment. This is just showing the share of new lending that is going to investors, which is not quite one for one with the share of purchases because some people buy without a loan, but it's a fairly good proxy for thinking about that. At the moment, in Queensland, in the blue on the left, 40% of new housing lending is going to investors. Not quite a record, but very close, as high as we've seen in decades. Same is true in WA, same is true in South Australia, same is true in the Northern Territory. We are seeing enormously high investor activity and representation in the buyer pool. That's true in New South Wales too. New South Wales, it's a bit off a record because, kind of early 2010s was even higher. But you have to go back to 2017 to find kind of a period where we're seeing equivalent investor activity in New South Wales. Even Victoria, we haven't seen a lot of investor activity in Victoria for a variety of reasons, but towards the end of 2025, we actually did start to see it pick up. You can see that increase there. So, investors being a really big part of housing markets is not a story unique to Queensland, though, the representation of investors in Queensland is very high relative to what's been typical for Queensland. All right, let's start to wrap up with a few themes that I think are going to be important over 2026 and beyond. And the first is new homes and residential construction. And the headline here is not a particularly positive one, which is we're just not building enough homes to hit the target pace for the 1.2 million homes over 5 years that National Cabinet set. You can see that in chart on the left nationally or chart on the right for Queensland. Red for detached houses, blue for higher density, so both semis and apartments. The big difference is really in higher density. You can see, back a decade ago, we built more high density than we do today, and we weren't actually that far behind that pace that we would need back a decade ago. At the moment, we're just not building at that sort of pace. Has been a lot of challenges in the new home sector over the last 5 years or so. We saw really rapid escalation in costs during the pandemic, which made it very hard for builders because it was just hard to commit to prices. It was a very uncertain environment. Prices are still high, they have not come back down, but cost growth has returned to a more typical pace. And so we're not in that environment of uncertainty now, which, while it's still a challenge because it is still a lot more expensive to build than it used to be, it's perhaps less of a challenge than it was a few years ago. Similarly, it's been very hard to find labour. There's some evidence that's starting to improve. We have seen a bit of a pickup in residential construction employment. And the other big headwind has been that it's been taking longer to build than it used to, particularly for detached homes. Again, it is still taking longer, but it's starting to come back down. So we're headed in the right direction there. So while at the moment it's not a particularly rosy picture for the residential construction sector, we're still well behind, where the target pace. There are some signs that things are starting to improve. Another big theme this year will be first home buyers. And the reason for that is that we saw some policy changes at the end of last year to support first home buyers from the federal government. So those two are the Australian government 5% deposit scheme, which does what it says on the tin. It allows more or less any first home buyer to buy with a 5% deposit without having to take out LMI. This program's actually existed for a while, but on 1 October it was changed to remove income eligibility caps. So you used to previously have to be under a certain income, and also to remove a cap on the number of places. It was previously capped at 50,000 places a year. That cap's now been removed. There are still caps on the price of the home, though they're relatively high for a first home buyer. So it's about a million it is a million in Brisbane, which that will rule out some first home buyers. Certainly some first home buyers will be looking at more expensive homes than that. But for many, that may not be a big constraint. The other program is a newer one, the Help to Buy scheme, which is a shared equity scheme. So the government buys a stake in your home alongside you. That launched in early December, so still really quite new. The 5% deposit scheme is going to be a much bigger scheme. The Help to Buy scheme is capped in both income and number of places. So we'd expect to see more effect from that. It is still early days. It only started in 1 October, but there is maybe some evidence we're starting to see a pickup in first home buyers from it already. So this chart here is just showing the number of new first home buyer loans across Queensland. And you can see right at the end of the chart there, which is the last 3 months of 2025, a bit of a tick up in the number of first home buyers. Now, of course, the number of first home buyers moves around every quarter for a variety of reasons, so we can't exactly pin it on this. And certainly this would be quite fast for an effect from a policy that only came in on 1 October. For someone to apply for a place, find a home, settle in 3 months is relatively fast. But there's maybe some evidence there that we've started to see some effect from these policies. And I think we'll probably continue to see that, as the policy gets more embedded and, more first home buyers have the opportunity to take it up. So I think first home buyers are going to be an important part of housing markets. They are still a relatively small cohort, compared to other buyers. But I think we'll see some pull forward of first home buyer demand as a result. Just to wrap up, we kind of started my remarks by talking about inflation, and I'm going to end there as well, but with a bit more of a forward-looking focus. And I always like this chart because it kind of underlines just how important inflation is. So what this chart here is showing is in black the actual RBA target cash rate, and then in the different colors what markets were expecting it would do over the coming 18 months to 2 years. And so in red is what we're expecting late October, not even that long ago, really. But critically, before we got the September quarter inflation data. So at this time, inflation looked like it was back in the band. People were expecting another couple cuts because things looked like they were going pretty well. But then we get the September quarter inflation data and we jump to the blue line, which is from early January, but you could take it earlier. Inflation looks like it's more persistent. That looks like it's going to drive RBA hikes. And so we move from expecting two cuts to expecting, probably one, maybe two. And then in late January, after that blue line, we get the December quarter inflation data, which shows that actually no, inflation is as bad as we thought. In fact, probably worse. It does look quite persistent. And we move to the purple line, where even from here, where we've already had one hike, another one's priced in, and there's a 40 to 50% chance of a second one by the end of the year. So the point to make here is kind of twofold. One, that's the outlook for interest rates, which is important. But two, it's inflation that is driving this outlook at the moment. And so, when we get more inflation data, which we will every month now, because inflation comes out every month now, if it starts to come back down, this picture could change and could change quite quickly. In a period of less than 4 months, we've gone from two cuts to, three hikes or two and a half hikes. So if inflation actually turns out to be relatively transient, things start to head back in the right direction, start to head back towards the RBA's target band, we may not see as many hikes as we're expected. But if inflation does evolve as the RBA is expecting, we'll probably see those, at least one, probably two hikes or potentially two hikes by the end of the year. I will wrap up there. Thank you very much for your time. I hope you found that helpful.